Enron. Everyone's heard of it. Your mom, your dad, your little twerp of a nephew. But what the fuck do they know about Enron? Probably not much, right? Well, after watching this video, you'll finally be able to tell your little turd of a nephew the main reasons Enron collapsed. There were a lot of assholes who played a role in the toxic culture and fraud that ultimately imploded Enron. But in this video, we're going to focus on the two most destructive assholes in this story, those being Jeff Skilling and Andy Fastow. First up is Jeff Skilling. This guy was always a little Mr. Smarty Pants. So much so that during a Harvard admissions interview, he was asked if he was smart, which seems like an easy question for Harvard, but whatever. And Skilling replied, quote, "I'm fucking smart." Okay, bro, you're smart. We get it. Skilling's huge brain ultimately got him a job at Enron. After working as a McKinsey consultant for the company, he came up with a new way to trade energy contracts, eventually laying the foundation for the natural gas futures market. Okay, that's pretty smart, I guess. Well, Skilling eventually became president of Enron, second only to CEO Kenneth Lay, affectionately known as Kenny Boy, to then-President George Bush. Unfortunately for Enron, Skilling had another galaxy-brained idea that would sow the seeds of its destruction. What was this whopper of an idea? Well, after Skilling was hired for his energy trading concept, he insisted on the use of an accounting method called mark-to-market. Mark-to-market is basically when you have an asset, typically a financial asset like stocks or bonds, that fluctuate in price, and then reflecting those unrealized gains or losses in the income statement. Okay, so pretty straightforward, right? No, of course not. As a publicly traded company, Enron had to get permission from the SEC to use mark-to-market accounting. The SEC was rightly skeptical, but after months of back and forth, and Enron insisting there would be no issues related to, quote, significant judgment by management, the SEC finally relented. But why would the SEC be concerned about significant judgment? Well, it's easy to use mark-to-market when you're dealing with a liquid asset traded on market with quoted prices. The problem with Enron was they were using mark-to-market for their long-term contracts to deliver natural gas. All right, so what's the problem here? Well, when you don't have an active market or a comparable asset to price a contract, you have to create a model to come up with the value. That means Enron would estimate the future cash inflows and outflows and book revenues and expenses in the period the contract was signed. A couple problems. One is their contracts lasted up to 20 years, so estimating cash flows was a total crapshoot. Second is that, like every other normal company, they should have recognized revenue and related expenses in the period they actually occurred. With the long time frame of these contracts, Enron management was essentially pulling numbers out of their asses. It's no wonder Skilling and his cronies were popping bottles of champagne after they got the green light by the SEC to commit fraud. Alright, let's look at an example of this bullshit. In 1992, Enron made a deal with a New York utility company called Scythe Energies. Enron was obligated to supply 195 million cubic feet of gas per day for 20 years for its new plant in upstate New York. Enron's managers estimated the value of the contract to be between $3.5 and $4 billion. Using mark-to-market accounting, Enron began recognizing revenue before the plant even opened and way before Enron received any cash from the deal. And over the years, Enron would repeatedly restructure this deal so that they can mark up the value of the contract and book more profits. Fake profits, to be sure. What's hilarious about this, at least from an accounting perspective, is that because Enron would go bankrupt 9 years later, over half the revenues they booked would never actually be earned, using basic revenue recognition principles. After a while, Enron started to rack up an alarming number of contracts with fake numbers and a lack of capacity to actually execute on them just so they could nail their earnings estimates and please Wall Street. Once it became obvious that these contracts were potentially deadly to Enron's balance sheet and income statement, someone had to step in and clean up the shit. And that shit custodian was CFO Andy Fastow. Fastow was hired by Skilling, so you know he was probably a good guy. Allegedly a finance wizard, Fastow had his work cut out for him, making Enron's financials the shiniest turd they could be. What was his secret weapon? The Special Purpose Entity. Special Purpose Entities, or SPEs, are companies that are created to fulfill a specific purpose, usually to obtain cheaper financing. They do this by transferring an asset that generates cash flows to the SPE. Then the SPE gets a loan from the bank backed by the asset and hands the cash over to the parent company. If the independence rules are met, the debt stays on the SPE's balance sheet rather than the company. Another bonus was that Enron was able to recognize transfers of assets to SPEs as sales and book gains in the income statement. All of this was predicated on the idea that these SPEs were actually independent from Enron. As we will see in a moment, that was definitely not the case. Alright, let us look at an example. In mid-1999, Enron began construction of a natural gas plant in Cuiabá, Brazil. The plant would supply a natural gas pipeline that connected Brazil and Bolivia, cutting through an endangered forest. By fall of that year, the project was experiencing serious problems. Enron wanted to reduce their stake in the venture, but no one else wanted to touch it. Normally, an asset like the Cuiabá plant would be written down, with the loss hitting the income statement. But why would they want to do that? Their precious stock price might take a hit. Well, here came Fastow to the rescue. Fastow's partnership bought a 13% stake for $11.3 million in the joint venture that owned Cuiabá. After the sale, Enron was able to keep $200 million in debt off balance sheet while recognizing $65 million in mark-to-market profits on a gas supply contract. The timing was perfect. The plant's business prospects continued to decline, later referred to as Enron's nuclear waste. So this must have been good for Enron, right? Well, not really. 2 years later, Enron repurchased the stake in Cuiabá at a higher price, giving Fastow's partnership a tidy $3 million profit. But why would Enron do this? Skilling later claimed that Enron's Brazilian staff lied to Fastow's partnership about the project, which required Enron to buy back the partnership's interest. However, it was later discovered during an investigation, Fastow and Enron made a backdoor agreement, with Enron promising it would repurchase Fastow's interest with a guaranteed return. Sneaky, sneaky. Okay, so what's wrong with this? Well, in order for Enron to benefit from SPE accounting, they had to follow the independence rules. First, there needs to be an independent investor. Second, the SPE needs to be controlled by someone other than the sponsoring company, in this case, Enron. And third, the investors and creditors retain all potential risk and reward related to the transferred assets. Well, if we analyze this example, we see that Andy Fastow was in charge of the SPE that bought the stake in the Cuiabá plant. This is an obvious conflict of interest. Fastow negotiated in a way that was best for his partnership and not Enron. The other glaring issue was that because of the repurchase agreement, Enron didn't truly remove the potential risks and rewards related to the Cuiabá assets. So it was not a true sale. Not only that, but any debt that Cuiabá took on should have been consolidated on Enron's balance sheet. The only purpose of this transaction was to provide short-term accounting profits and temporarily warehouse Enron's underperforming asset. Ultimately, Enron was only shuffling around Cuiabá within the company, taking huge economic losses that were made worse by Fastow siphoning off millions from the transaction. Given the huge volume of contracts on Enron's books that were falling apart, Fastow had to create hundreds of SPEs to trick investors and creditors into thinking Enron was supremely profitable. Ultimately, Enron's debt and losses spiraled out of control. They couldn't keep up the charade any longer. On October 16, 2001, Enron was forced to restate earnings for the years 1997 through 2000. Over that time frame, earnings were overstated by $1.6 billion and equity by $2.6 billion. Even their 2001 quarterly reports overstated net income by $545 million and their equity by $828 million. Not long after, Enron's credit rating was downgraded to junk status. The former Wall Street darling declared bankruptcy on December 2, 2001, with their stock trading at 26 cents a share, down from a peak of $90 a share. Thousands of people lost their jobs overnight. Their retirement accounts, which were made up of nothing but Enron stock, were completely wiped out. Enron's story is clearly tragic, and many people play their role in that tragedy. Arthur Andersen, Enron's infamous auditor, rubber-stamped most of Enron's questionable transactions. The bankers were complicit in Fastow's dirty deals, and the corporate culture rewarded ruthlessness and short-term thinking. But there were two villains who really fucked shit up, and those were Jeff Skilling and Andy Fastow.